Today, we are focused on how the property and casualty exam will test you on the differences between a mortgagee, a loss payee, and an additional insured. The key to passing these questions is to separate them into two buckets: property rights versus liability rights. Mortgagees and loss payees are all about protecting a lender's interest in physical property, while an additional insured is about extending liability protection. Let's start with the mortgagee. This is almost always a bank or lender with a mortgage on real property, like a building or a house. The mortgagee has incredibly strong rights under the standard mortgage clause. This clause acts like a separate contract within the policy. This means that even if the insured does something to void their own coverage, like intentionally burning down the building, the mortgagee still gets paid by the insurer to protect their financial interest. The exam will test this by giving you a scenario where the insured commits fraud and asking if the lender still gets paid. With a mortgagee clause, the answer is yes. Now let's look at a loss payee. This is a party with a financial interest in personal property, not real estate. Think of a bank that financed a business's delivery van. Under a standard loss payee clause, the lender's rights are tied to the insured's. If the insured does something to void the policy, the loss payee gets nothing. This is a major exam distinction. To get around this weakness, lenders often require a lender's loss payable endorsement. This endorsement gives the loss payee stronger rights, very similar to a mortgagee, protecting them even as the insured's claim is denied. So a mortgagee is for real estate and a loss payee is for personal property. But a lender's loss payable clause gives the loss payee mortgagee-like protection. Now for the completely separate category, the additional insured. This has nothing to do with damaged property. An additional insured is a person or entity who is granted liability protection under another person's policy. The classic exam example is a landlord requiring a tenant to add them as an additional insured on the tenant's liability policy. If a guest trips and falls in the tenant's apartment and sues both the tenant and the landlord, the tenant's policy will defend the landlord. The exam trap is to confuse this with property coverage. If the tenant's negligence causes a fire that damages the building, being an additional insured does nothing for the landlord's property damage. The landlord needs to be a mortgagee or have their own property policy for that. Finally, the term additional interest is often used as a distractor. An additional interest is simply a party that gets notified if the policy changes or cancels, but they have no coverage rights. Here's a phrase to keep it all straight. Mortgagees and loss payees get paid for property. Additional insureds get protected from liability. The exam loves to mix these up in scenario questions, asking you to identify the correct status for a party based on whether they need property or liability protection. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.